Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge, Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
You ever watch a butterfly flap its wings and just accidentally trigger a $500 million avalanche?
Oh, it's wild.
Right, because you grow up assuming that global finance operates on this very, sterile, rational spreadsheet. Like, you expect economic data to move the market.
Absolutely, yeah. You expect logic.
Exactly. But then you look at what happened on April 8th, 2026, and that entire rule book just evaporates. You suddenly realize the spreadsheet is actually, it's completely at the mercy of real-time, chaotic human drama.
I mean, we are looking at a complete paradigm shift in how we track cause and effect here.
Yeah.
The traditional economic indicators, interest rates, quarterly earnings reports, supply chain metrics, those are basically lagging indicators now.
Right. They're old news by the time we see them.
Exactly. The real-time leading indicator is literally a social media feed. We're watching this incredibly interconnected ecosystem where, the political rhetoric of just a single world leader can instantaneously alter the liquidity of an entirely decentralized, borderless financial network.
So true. Well, today we are opening up a stack of sources from an April 2026 financial and cryptocurrency update. And our mission for you is to decode these massive whiplash-inducing shifts.
And there are a lot of them.
Oh, totally. We are looking at how military deadlines in the Middle East are directly crashing into blockchain stress tests and, billion-dollar Wall Street funds. We're going to extract the mechanisms behind these events so you can walk into your next conversation understanding exactly how the modern geopolitical machine actually operates.
It's a lot to unpack, but it's crucial stuff.
It really is. But before we dive into the deep end, I do need to do a quick level set on the sources we're using today.
Always a good idea.
Yeah, because today's documents elucidate some pretty heavily charged political waters. I mean, we're covering everything from U.S. election year maneuvering to military actions in the Middle East and South America.
Right. Very sensitive topics.
Very. And our job here is not to take a political side or, cast moral judgments on any of this. We are acting entirely as your analytical mirror, just reflecting the factual claims exactly as they're presented in the source material.
Yeah, so you can just see how the global markets are digesting and, reacting to these intense real-world moves.
Exactly. So let's start with the catalyst. How did a literal military deadline in the Middle East instantly trigger the best day for crypto ETF inflows in, 6 weeks?
Yeah, 6 weeks. The chain reaction really begins with what the sources refer to as Operation Epic Fury.
Okay, let's unpack this. What exactly is that?
Well, we have this scenario where President Donald Trump issues a highly specific, highly public 8 p.m. Eastern Time deadline to Iran, and it's accompanied by threats of severe civilization-altering consequences.
Wow.
Yeah, this is maximum geopolitical tension. But instead of playing out entirely in closed-door, classified diplomatic cables like you'd expect, the resolution happens right in the public square.
Right, because according to the files, before that clock ran out, Pakistan's Prime Minister, Shehbaz Sharif, along with Field Marshal Asim Munir, stepped in to intervene.
Which was a massive pivot.
Yeah, they requested a 4-week extension to basically halt the military momentum and open up negotiations. And then the actual diplomacy plays out online.
Literally on social media.
Exactly. Trump posts on Truth Social announcing a 2-week double-sided ceasefire. He notes the U.S. had exceeded its military objectives, mentions a 10-point proposal from Iran that serves as a workable basis for peace.
And crucially, he demands the complete, immediate, and safe opening of the Strait of Hormuz.
Which is huge, right?
Oh, it's everything. The Strait of Hormuz is the absolute jugular of global oil supply chains.
Right.
I mean, roughly a fifth of the world's total daily oil consumption passes through that narrow waterway. So when that strait is threatened, every financial model on Earth just starts flashing red.
And then Iran's foreign minister, Abbas Araki, responds directly on X. He confirms on behalf of Iran's Supreme National Security Council that they accept the 2-week halt to defensive operations.
It's wild to see it happen in real time like that.
It really is. He cites a 15-point U.S. proposal and explicitly agrees to allow safe passage through the strait. So we're watching a high-stakes geopolitical standoff resolve basically on social media with global supply chains just sitting in the middle of the poker table.
Yeah.
But looking at the market's explosive positive reaction, I have to wonder, is the market reacting to peace, or are they just reacting to the clarity of knowing the Strait of Hormuz will remain open for the next 14 days?
Well, what's fascinating here is that markets fundamentally despise uncertainty far more than they despise bad news.
Wait, really? More than bad news?
Well, for sure. If an event is objectively terrible, analysts can still build a statistical model around it, you know? They can price in the damage.
Right, they know what they're dealing with.
Exactly. Uncertainty, however, cannot be modeled. A potential closure of the Strait of Hormuz introduces just, like, infinite variables into the cost of global shipping and manufacturing.
So the moment that 2-week ceasefire was publicly confirmed, that infinite variable was removed.
Bingo.
Yeah.
The sudden clarity around those vital oil routes immediately eased the tension. I mean, if you look at the crypto market's primary sentiment metric, the Fear and Greed Index, it had been sitting in a state of extreme fear.
And
The second this diplomatic exchange hit social media, that metric plummeted straight down to a regular fear rating of 38.
wow, and when that fear metric drops, the institutional floodgates just swing wide open.
Oh, totally.
Because our sources detail that crypto ETFs saw a staggering $591.6 million in inflows in a single day.
Which is just massive.
It's the best performance the market had seen in almost 6 weeks. Spot Bitcoin ETFs alone swallowed up $471 million of that new capital. We're talking about major Wall Street titans here, BlackRock, Fidelity, ARK, moving massive amounts of capital, pushing total ETF assets back above the $90 billion mark.
Yeah, and even Ethereum ETFs caught the tailwind with $120 million in inflows. And the price of Bitcoin itself reacted, hitting $69,800, bringing its market cap to $1.39 trillion.
But here's where it gets really interesting to me. This presents a massive contradiction in the data.
Oh, so?
Well, you have nearly $600 million flooding into these traditional Wall Street-wrapped crypto products, right?
Right.
But when you look at the actual decentralized exchanges, the DEXs, the places where people actually trade crypto natively, the volume is practically dead.
Oh, yeah, that's a great point.
Uniswap is hovering at just $1.25 billion in 24-hour volume. The total decentralized finance, or DeFi market cap, sitting at $50.2 billion, but the daily trading volume is well below $10 billion.
Yeah, it's a huge disparity.
And if we look at stablecoins, which kind of act as the lifeblood of crypto trading, Tether's USDT volume is only $74.6 billion, and USDC is at an anemic $1.17 billion. So I got to push back here. If hundreds of millions of dollars are pouring into the crypto space via ETFs, why is the decentralized engine room so incredibly quiet? Are people just hoarding?
Well, it comes down to the mechanism of how different investors interact with risk. Think of the crypto ecosystem like a massive experimental theme park.
Okay, I like that analogy.
Wall Street investors are currently buying millions of dollars worth of stock in the company that owns the theme park. They want exposure to the park's overall value going up.
Right.
But they have absolutely zero interest in actually walking through the turnstiles, learning how to operate the rides, or, holding their own tickets. They want it safely inside a regulated, familiar ETF structure where a custodian holds the keys.
Ah, so they're completely insulated from the actual tech.
Exactly. Meanwhile, the retail investors and the native DeFi users, the people who actually operate the rides, they're looking at the broader macroeconomic picture and choosing to sit on their hands.
So they're the ones driving that stablecoin volume down.
Yeah, when you see stablecoin volume drop that low, you are looking at the reserve currency of the crypto world just freezing up. Traders are converting their volatile assets into stablecoins and just holding them.
waiting to see if this 2-week ceasefire holds or if things deteriorate again.
Precisely. The big money is treating crypto strictly as a digital gold to hold during geopolitical stress, and they're completely bypassing the active, decentralized protocols the technology was built on.
Right. But because billions of dollars of institutional money are now locked in these traditional ETFs, the underlying infrastructure of the blockchain has to be absolutely bulletproof, doesn't it?
Oh, it has to be flawless.
Because a single technical vulnerability on the Bitcoin network isn't just, a quirky coding glitch anymore. It is now a systemic risk to Wall Street.
Yeah, the pressure to mature the technical foundation and the legal foundation simultaneously is immense. A failure on either front could trigger a mass exodus of that $90 billion in ETF capital.
And our sources show exactly how the developers and the regulators are frantically running drills to secure that foundation.
We're working overtime, yeah.
Like, on the technical side, between April 8th and 9th, Bitcoin developers ran operations on the Signet test network. They were deliberately deploying what are called attack blocks.
Right, to demonstrate a vulnerability related to the new BIP54 upgrade. That's the Bitcoin improvement proposal.
Exactly. And to understand the stakes here, you have to understand the mechanism. Signet is essentially a digital sandbox.
Yeah, it's a parallel test version.
Right. It mimics the real blockchain, but the coins on it have zero real-world value. So developers purposely craft malicious data packets, these attack blocks, and flood the network with them.
Just to see if the network correctly identifies and rejects the bad data without slowing down legitimate transactions.
It's literally a digital fire drill. They are intentionally trying to break the system in a controlled environment to ensure that when BIP54 goes live on the main network, the building doesn't burn down while Wall Street's money is sitting inside.
That's a perfect way to put it. And, this raises an important question because while the developers are stress testing the code, the regulators are fundamentally rewriting the legal code.
Oh, right, the SEC news.
Yeah. Over at Vanderbilt University's Digital Asset and Emerging Technology Policy Summit, the new SEC chair, Paul Atkins, held a fireside chat where he outlined this massive structural shift in how the government views these assets.
The innovation exemption, right?
Exactly. Under this proposed framework, startups might soon be able to raise up to $5 million over 4 years with only basic disclosures to the SEC, or up to $75 million if they provide comprehensive financial disclosures.
That's a huge shift.
It is. And most crucially, under this safe harbor, most crypto assets would be treated strictly as non-securities unless they are explicitly tokenized versions of traditional securities, like a stock or a bond.
Okay, wait. Allowing startups to raise $5 million with minimal disclosures. That sounds incredibly risky.
It definitely raises eyebrows.
I mean, doesn't this risk sparking a total reboot of the initial coin offering, that whole ICO era of the late 2010s?
Yeah.
Where anyone with a white paper and a website could raise millions for projects that just completely vanished.
Yeah, the tension you're pointing out is the absolute core debate in financial regulation right now. It's that balance between fostering innovation and protecting consumers from fraud.
Right.
And to understand why Chair Atkins is proposing this safe harbor, we really have to look at the legal mechanism the SEC has historically relied on, which is the Howey test.
Oh, the old Citrus Grove case.
Yeah, exactly, from 1946. The Supreme Court case involving the W.J. Howey Company, which sold tracts of citrus groves in Florida to buyers who then leased the land back to the company to harvest the oranges.
Right, so the court ruled that an investment contract exists if you invest money in a common enterprise with the expectation of profits driven solely by the efforts of a third party.
Exactly. But applying a 1940s legal test designed for Florida citrus groves to a decentralized computing network creates an impossible paradox.
Thus so.
Well, if a startup wants to build a new decentralized network, they need to sell tokens to fund the development and incentivize users to join, right?
Makes sense.
But under the Howey test, selling those tokens before the network is fully functional makes them an unregistered security, which brings the full crushing weight of legacy financial regulation down on, a team of 5 engineers.
Oh, wow. So the regulatory hammer falls so early that it strangles the development before the tech even has a chance to work?
Precisely. So the safe harbor exemption is the SEC's attempt to bridge that gap. They're proposing a grace period.
Just to let them build the network first.
Yeah, they're saying to developers, look, We will let you raise the initial capital, build the network, and achieve actual decentralization before we decide if legacy securities laws apply. The SEC is basically calculating that the risk of a few bad actors running scams is outweighed by the macroeconomic necessity of keeping this development inside the United States.
And keeping the capital it generates here, too.
Exactly.
So what does this all mean? Because this technology is no longer confined to digital coins on a screen, the regulatory breathing room the SEC is proposing is directly enabling the next phase of this industry, which is bleeding into the physical world.
Oh, big time. Real-world assets.
Yeah, our sources detail a major joint venture launching right now in the Abu Dhabi global market. We are looking at a partnership between the Alpha Ladder Group, Metacom, and MCM International.
And their goal is to link the financial ecosystems of Singapore and the UAE using Metacom's StableX network.
Right, and they aren't just trading digital currencies. They are tokenizing real-world physical assets. They are taking physical infrastructure and real estate in the Middle East and North Africa region and creating digital twins on a blockchain.
And the sheer scale of the capital involved here completely dwarfs the cryptocurrency market. I mean, Alpha Ladder utilizes NFT technology, non-fungible tokens, not for digital art of monkeys.
Right, not the JPEG era.
No, they use it as a mechanism for the real-time tracking of ownership, maintenance condition, and financial performance of physical buildings.
Wow. So by turning a skyscraper into a digital token, you can fractionalize the ownership.
Exactly. Allowing thousands of investors globally to buy shares of that building with instant liquidity, rather than going through months of traditional real estate closing procedures.
Which is huge. The sources actually project that the Gulf Cooperation Council tokenization market alone could reach nearly $500 billion by 2030.
$500 billion.
Yeah, they are tapping into an underlying digital payments market expected to hit $420 billion. And this isn't theoretical. Metacom has already raised $35 million and achieved profitability.
And MCRM brings decades of traditional experience managing physical assets to the table.
But $500 billion in tokenized physical assets requires a massive shift in how a society operates.
Yeah.
The UAE recognizes that you cannot manage a 21st century digital twin economy with a 20th century workforce.
Right, you need the human capital.
Exactly. And that brings us to the human capital side of the equation in our sources. Sorbonne University in Abu Dhabi just launched an AI short film competition for students called 20 Years, 20 Visions.
Oh, that's fascinating.
Yeah, they're inviting high school and undergraduate students across the UAE to predict and visualize how artificial intelligence will fundamentally reshape society, education, and career paths by the year 2046.
Looking way ahead.
Right. This initiative is tied directly to the UAE's National Strategy for Artificial Intelligence 2031. They are aggressively pushing the next generation to become native to these technologies because someone is going to have to manage, optimize, and regulate that $500 billion tokenized real estate market.
If we connect this to the bigger picture, it all aligns. The tokenization of real estate in Dubai, the AI education initiatives at Sorbonne University, the ETF inflows on Wall Street, and the military ceasefire in the Strait of Hormuz.
They seem disconnected at first glance.
But they're not isolated data points at all. They are gears in the exact same macroeconomic machine. And the fuel that powers this entire machine is global liquidity. And that liquidity is entirely dictated by the cost of energy and inflation.
Right. And our sources actually highlight a fascinating causal chain regarding the next U.S. CPI, the Consumer Price Index inflation data, dropping on April 10th via the Bureau of Labor Statistics.
Yeah, this is key.
Because we established earlier that the threat to the Strait of Hormuz could drastically spike global oil prices. Since oil dictates the cost of manufacturing and shipping virtually every physical good, a spike in crude oil directly drives U.S. inflation up.
And when U.S. inflation goes up, the Federal Reserve is forced to keep interest rates high to cool the economy down.
Because high interest rates make borrowing money expensive.
Exactly. Which means large institutional investors have less free capital to throw into high-risk speculative assets like crypto ETFs or tokenized real estate in Abu Dhabi.
But the geopolitical maneuvers we are seeing create a massive counterbalance to that inflation threat, right? Because the sources point out that the recent U.S. capture of Nicolas Maduro from Venezuela also included the vital step of securing multiple oil-filled ships.
And this is the mechanism that ties the entire global loop together. By securing those Venezuelan oil ships and bringing that supply to the global market, it acts as a pressure release valve against the fear of a Middle Eastern oil shortage.
So if that influx of South American supply increases the total global inventory, the price of crude oil drops.
Right, and when oil becomes cheaper, shipping becomes cheaper, and the U.S. CPI inflation data begins to cool down.
Oh, wow.
Yeah, if the April 10th data shows that inflation is dropping, the Federal Reserve gains the confidence to lower interest rates. And the moment interest rates drop, borrowing becomes cheap again.
So institutional investors suddenly have access to billions of dollars in cheap capital.
Exactly. And historically, that newly freed up capital flows straight down the risk curve, right back into the exact spot Bitcoin ETFs and the Abu Dhabi tokenized asset markets we have been dissecting today.
It is a breathtaking feedback loop. Let's pull all of these threads together for you. We started by watching a high-stakes, 2-week military ceasefire over the Strait of Hormuz get negotiated publicly on social media.
An incredible catalyst.
Right. That single action removed an infinite variable of uncertainty from the global supply chain, which instantly acted as a catalyst for a massive $591 million shopping spree in Wall Street crypto ETFs.
Yep.
And to protect that incoming institutional wealth, software developers are intentionally attacking their own test networks with malicious data blocks, acting as a digital fire drill.
At the exact same time.
Simultaneously. The SEC is attempting to overhaul decades-old citrus grove laws to create a legal safe harbor, giving startups the breathing room to build the infrastructure. And all of this technical and legal maturation is laying the groundwork for a looming $500 billion real-world tokenization boom in the Middle East, fueled by an inflation cycle that hinges on the capture of Venezuelan oil ships.
It's all connected.
It really is. The major takeaway for you is that the old traditional walls that used to neatly separate global geopolitics, legacy Wall Street finance, and decentralized technology, they simply do not exist anymore.
Not at all.
You can no longer analyze one of these sectors in a vacuum. To understand the trajectory of a decentralized protocol, you must understand the trajectory of a centralized military action.
And the convergence of these fields presents a rather profound paradox regarding the original ethos of cryptocurrency.
What do you mean?
Well, the entire philosophical foundation of decentralized finance was to build a system completely insulated from the whims of traditional governments and central banks, right?
Yeah, that was the whole point of Bitcoin in the first place.
Exactly. Yet the data we examine today shows that the most explosive growth and adoption of these quote-unquote decentralized assets was instantaneously triggered by an international military ceasefire negotiated by centralized world leaders.
Wow. Yeah, that's a huge contradiction.
It really is. If the underlying value and liquidity of decentralized money is so heavily dictated by the actions of traditional military power and traditional macroeconomic indicators, it forces us to ask a pretty difficult question.
Which is?
Is cryptocurrency actually functioning as an alternative independent financial system? Or has it simply evolved into the world's most sensitive real-time thermometer for tracking geopolitical stress?
Oh, that is the exact tension sitting at the center of the modern financial system. An alternative reality or just a hypersensitive thermometer for the one we already live in?
Yeah, it's something to think about.
We will leave that thought hanging in the air for you to examine today. Thank you for joining us on this deep dive. Keep questioning the mechanisms driving the world around you. Keep looking for those real-time catalysts, and we will catch you on the next one.